Good morning, everyone, and happy spring. It's been a while since we've had a video here, and so Bruce, Bob, and I thought that we would send something out. I know it's been a little bit different here in the markets, and since I've been an advisor, there hasn't really been a normal, and so kind of wondering what Bruce and Bob's thoughts are on that.
Normal. It's normal that your former president is a convicted felon. Is it normal that the current president thinks his uncle got eaten by cannibals? I mean, what's normal anymore? But, all kidding aside, it does feel like we're getting back to a normal. And, people haven't been privy to our investment committee meetings about how uncomfortable it's been for us that we feel like we haven't really needed to make any moves. Isn't that so, Bob?
It is, and as all three of us have talked a lot, it's been so long since it's been normal. Normal doesn't feel normal, and really it goes back, I mean, almost 20 years at this point, right? I mean, we hit that 08, 09 period where we just had really the worst financial disaster, since the Great Depression. I mean, the economy seized up, capital markets seized up, stock markets lost, the S&P 500 lost 57%, but things like the NASDAQ were down even more. Lehman Brothers and Bear Stearns, and, giant investment firms, 100-year-old firms went under, right? The markets just, we didn't know what the future held at that point in time. And the Federal Reserve came in and they established what they call ZIRP, or zero interest rate policies. And we've been basically living on free money now, for a long time, and things are starting to get normal again. It took a long time to get out of that recession. Things started to normalize, then we kind of got into the late, teens of the 2000s, 2016, 2017. Things are just starting, they started raising rates, things are getting back to normal, and then the pandemic came along, and we've all, that's in our memories, that's still recent in our memories. We know what happened there. Again, back to zero interest rate policies, we shut economies down. It's just been so weird for so long that now that we're finally in a normal state, it just doesn't seem normal. And I know we talk about this where if you manage money, you're sort of insecure by nature, but you don't have anything to worry about, you get very worried. And while there's always certainly plenty to worry about, when we look at the world today, we'd say we have really solid trend to slightly above trend earnings growth. Corporate earnings continued to come in very strong. Q1 came in around 6.3% versus a 1.2% estimate. Inflation continues to moderate. The Fed's inflation number just came out that they like to look at, the PCED, 2.7%. Continues to move towards the 2% target. Employment is full. Things are okay right now in the economy. And yes, interest rates, we'll say, well, interest rates are really high. Interest rates are actually well below the long-term averages at this point. Paying 6.5%, 7% for a mortgage is a nice number. It's what a mortgage should cost you. You're not supposed to be able to borrow for free. You're not supposed to be able to get your car loans for 0.9%. So we're not foolish enough to think that this won't get disrupted relatively soon by something probably that we could not predict. But in the meantime, we look out and we look at things like the longer term forecast for corporate earnings, et cetera, over the next 3 years, and we apply the multiples we apply and all that. And really, if I was going to make any argument at all, maybe markets are slightly overvalued a little bit, but they're really overvalued because of the big tech stocks, and the big tech stocks continue to produce the growth in earnings rate. The earnings growth rate continues to be high enough that it justifies that little bit higher valuation. So I don't want to say there's nothing to worry about. That would be foolish. There's always things to worry about. There's things that we don't know about that we need to, so that will certainly happen. But as of right now, the economy's in a pretty solid area, and we're gonna stick with kind of the plan at this point. It's nice to see the fixed income portion of the portfolio is making a little bit of money, and that's where we are right now. A bit of a holding pattern.
Speaking of worry, for all of you out there watching, the good news is you don't have to worry because you pay us to worry for you. And we're going to continue to do that. We do this investment committee meeting pretty much every Friday, and sometimes more often as necessary. I'd be remiss if I didn't tell you that there's a fourth member of our investment committee. He's been an kind of an unofficial member for the last year. His name's Alan Vandekreek. Alan's going to be a new advisor with our firm, and he's joining us next month. As a matter of fact, today he's driving his belongings across the country from Boulder to Marquette. And so you'll be able to meet Alan in the near future with a Zoom or here in our office. But I want everybody to know that on behalf of Bob and Jessica and myself and soon to be Alan, we are watching this stuff and we talk about it all the time. Jess, do you have any final worries or comments or concerns that we should be talking about?
No, it's interesting, we have lots of clients that will talk about interest rates, like you mentioned, Bob, about how, getting a mortgage for 6% is ludicrous. But I think the more we talk about it and the more we tell them, and that's what normal should be, I think it, is best. So I wish everybody a great summer, and we look forward to seeing everybody, in the near future. We are going to have some events here towards fall, so look for those invites. But everybody relax and kind of go with the flow. Take care, everybody. Thank you.
Bye-bye. Thank you.